Hi, welcome to the Economic Plant. Before we start this video, please do not forget to subscribe to the channel and like this video. This will help the channel tremendously. Sit back, relax, and enjoy this video. The stock market is currently anticipating one of its worst years ever. The S&P 500 index lost 23.9% in the first 9 months of 2022. There have only been 5 full calendar years with worse returns: 2008, 1974, and the 3 years of the Great Depression. Even though the market's recent history paints a bleak picture of what has happened thus far this year, it also has a positive side for long-term investors. Bear markets like the current one are typically brief, and investors who maintain their composure typically do well. The American Association of Individual Investors Vice President Charles Rotblut recently noted this in a tweet. In addition to being well within the typical range of previous bear markets, he added, "Those who stick with their allocations get rewarded for doing so." Sam Stovall, the chief investment strategist at CFRA, examined 13 bear markets dating back to 1945, which are those that saw a decline of at least 20% from market peaks. The current bear market is one of what Stovall refers to as garden variety bear markets, which are characterized by a stock market decline of 20% to 40%. The others, which experience drawdowns of more than 40%, he refers to as mega meltdown bears. The latter type, with an average duration of just under 2 years and an average decline of 51%, is particularly difficult for investors. The common bear is a little less frightening. These periods typically last 13 months on average, with a 27% drawdown on average. Importantly for investors, stocks, on average, return to their peaks after these downturns in just 27 months. For the more ferocious bears, the average time to recover is almost 5 years. Staring at red numbers in your portfolio for 2 or 5 years may seem like a very long time, but if you've been investing for years, a short period of time is insignificant. Furthermore, Rotblut advises against selling during bear markets and instead advises adding to your portfolio. Have you ever viewed a chart and wished you had purchased a stock when it was trading at a lower price? So why don't you buy right now, he asks. No one is certain of the bottom's location, but we do know that stocks are currently discounted. The market may not have reached its low point for some time, so making a sale before things deteriorate could increase your profits in the long run. But for 2 reasons, experts say it would probably be a mistake. 1. Even if you are correct that the market will continue to decline, selling now would require you to predict when it will be profitable to re-enter the market. What is your policy for entering the market once you cash out? What will you employ as a marker? Rotblut asks, and what happens if you don't do anything then? It is extremely difficult to time the market, and getting it wrong could severely reduce your returns. According to Putnam Investments, a $10,000 investment made at the end of 2006 in a fund that tracked the S&P 500 would have increased to almost $46,000 by the end of 2021. However, if you take away the 10 best days from that 15-year span, the sum drops to around $21,000. The best way to profit from stock market gains, according to Putnam researchers, is time, not timing. The second reason is that markets have historically rewarded investors for entering the market after it has experienced a decline, similar to what investors have seen so far this year, even though past performance is no guarantee of future results. According to data from Compound Capital Advisors, the first 9 months of 2022 rank among the worst 29-month spans of the previous 50 years as measured by the Wilshire 5000, a broad U.S. stock market index. With the exception of one case, the index experienced a positive return with an average return of 12% in the year that followed the 9-month decline. The index showed positive results each of the following 3 years, averaging gains of 41%. Has selling after large 9-month declines been a good strategy for long-term investors in the past? Read a straightforward tweet from Compound CEO Charlie Baleo. No.